Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us prepare now common size statements based on final accounts of company given in the question. Let us go through the question. Coast Limited submits following summary statements for the year 2013. Opening stock, cost of goods sold, purchases, cost of goods sold, office expenses, administration expenses, selling expenses, depreciation on assets let out. So this cannot be a part of cost of goods sold. This is an asset which we have given on a rent, that is let out. Provision for tax will be deducted from net profit before tax. Sales, that will be the first item of income statement. Closing stock. While calculating cost of goods sold, closing stock will be deducted. Income from assets let out. Non-operating income. Income from assets let out. Non-operating income. Let us go through the balance sheet. As on 31st December 2013, share capital is part of shareholders fund. Reserves and surplus, part of shareholders fund. Creditors, current liabilities. Cash, current asset. Debtors, current asset. Stock, current asset. Bank overdraft, current liability. Provision for taxation, current liability. Less tax paid, this is advance tax paid, current asset. Let out assets cost minus depreciation, so will be part of fixed assets. Prepare vertical common size statements. Coast Limited common size income statement for the year ending 31st December 2013. Particulars, all amounts they are given in thousands. So in thousands rupees, and these two are percentage columns. We have to first start with the sales. Sales 5,000, 1,000. Sales minus cost of goods sold. In cost of goods sold, we are required to consider opening stock, purchases, closing stock. Opening stock 200,000, add purchases 4,000, total 4,200,000, less closing stock 200,000. So cost of goods sold we have 4,000, sales 5,000, less cost of goods sold 4,000, we get gross profit 1,000. From gross profit we are required to deduct operating expenses. In operating expenses we have office expenses, selling expenses. Office and administration expenses 80,000, selling expenses 160,000, total operating expenses 240,000. This will be deducted from gross profit to arrive at operating profit. Operating net profit 760,000. To this we will be adding non-operating income. Income from asset let out means assets are given on hire basis to receive rent on the assets. So actual income received, rent received or hire charges received 640,000. This is non-operating income. Operating net profit 760,000. To this we add non-operating income, income from asset let out 640,000. So it becomes 1,400,000. From this we are required to deduct non-operating expenses. Depreciation on assets let out 400,000. This is non-operating expense. After adding non-operating income, we got 1,400,000. From this we are going to deduct depreciation on assets let out 400. So net profit before tax will be 1,400 minus 400, 1,000. Provision for tax we have 320,000. net profit after tax 680,000. So we have completed vertical income statement. Let us convert this into common size income statement. For that purpose, we are required to take sales, net sales as what? Rupees 100. 5,000 we are required to consider as 100. Accordingly, all values in income statement will be converted as per rupees 100 taking base of 5,000. For example, opening stock 200,000. 200 divided by 5,000 multiplied by 100. Opening stock 4%. Purchases 4,000 divided by 5,000 multiplied by 100. 80%. Opening stock plus purchases, it is 84%. Closing stock 200,000 divided by 5,000 multiplied by 100. It is 4%. Cost of goods sold, we have 4,000. That is equal to purchases, so it will be same as 80%. Gross profit 1,000 divided by 5,000 multiplied by 100. It is 20%. Operating expenses, office and administration expenses 80,000 divided by 5,000 multiplied by 100. 1.6%. Selling expenses 160,000. 3.2%. 240,000 total operating expenses. 4.8%. Operating net profit 760,000. 15.2%. Non-operating income from assets let out 640,000. 12.8%. After adding non-operating income, it is 1,400,000. It is 28%. Non-operating expense, depreciation on asset let out 400,000. It is 8%. Net profit before tax 1,000. Net profit before tax 20%. Provision for tax 320,000. (6.4%). Net profit after tax 680,000. Finally 13.60%. We have completed common size income statement. Now we'll proceed to prepare common size balance sheet. Coast Limited, common size balance sheet as on 31st December 2013. Amounts are given in thousand. First part of balance sheet, sources of funds. There first we'll have shareholders fund. In shareholders fund, first item will have share capital. Share capital 800,000. To this we are required to add reserves and surplus 1,392,000. Share capital 800,000, add reserves 1,392,000, total shareholders fund 2,192,000. To this we are required to add borrowed funds. There are no borrowed funds in balance sheet. So finally we can arrive at capital employed, which is equal to shareholders fund. Total capital employed 2,192,000. We have completed first part of the balance sheet. Let us start with the second part of balance sheet, application of funds. Application of funds. There first we have fixed assets. Let out assets cost 3,200 less accumulated depreciation 1,200,000. So WDV is 2,000. Let out fixed asset 3,200,000 less provision for depreciation 1,200,000, net block or WDV 2,000. There are no long-term investments, so next item will be working capital. In working capital, first we are required to consider current assets 40,000, debtors 800,000, stock 200,000. Total current assets 1,040 thousand. From this we are required to deduct current liabilities. There we have creditors, bank overdraft, provision for tax, less tax paid, that is advance tax paid. Total current liabilities 848,000. From current assets we'll deduct current liabilities to arrive at net working capital. It is 192,000. This will be added to fixed assets to arrive at total assets. Total assets 2,192,000. We have completed vertical balance sheet. Let us convert it into common size balance sheet. For that purpose, this total assets we are required to take as 100. Similarly, total capital employed we are required to take as 100. It means capital employed 2,192,000 is taken equal to 100. Accordingly, all figures in balance sheet will be converted taking base of total capital employed 2,192,000 or total assets. For example, share capital 800,000 divided by 2,192,000 multiplied by 100. It is 36.5%. Next, reserves and surplus 1,392,000 divided by 2,192,000 multiplied by 100. It is 63.5%. Shareholders fund 2,192,000 divided by capital employed 2,192,000 multiplied by 100. So it will be 100%. We have completed first part of the balance sheet. Let us proceed for the second part. Fixed assets, let out assets cost, that is gross block 3,200,000 divided by 2,192,000 multiplied by 100. Hundred and 45.99%. Less depreciation 1,200,000 it is 54.74%. Net block WDV 2000. Net block 2000 divided by capital employed 2192 multiplied by 100. So it is 91.24%. Next, working capital. In current asset we have cash 40,000. Cash 40,000 divided by 2192,000 multiplied by 100. 1.82%. Debtors 800,000. (36.5%). Stock 200,000. (9.12%). Total current assets 1,040,000. Total current assets 47.45%. Creditors 640,000. (29.20%). Bank overdraft 200,000. (9.12%). Provision for tax net 8,000. (0.36%). Total current liabilities 848,000. Total current liabilities 38.69%. Net working capital 192,000. (8.76%). Thus we have completed common size balance sheet. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.